When you're just a beginner, everyone tells you the same thing. Diversify. Spread your money around. Play it safe. But the hard truth is that diversification limits you to average results. It keeps you safe from big losses, yet it also means you won't win big. That's why some big investors choose the concentration style, focusing on a few opportunities they believe in instead of spreading money everywhere. It's riskier because one failure hurts, but success can bring bigger rewards. This style needs knowledge, patience, and discipline, and it appeals to those aiming for more than average results. So, if you're a beginner investor who wants bigger results than average, this video is for you. We'll talk about how to prepare to use concentration wisely, how to handle risks, and how to stay focused on your choices. Let's get started. Concentration versus diversification. When beginners start investing, they often wonder whether they should spread their money out or put it into just a few choices. Diversification means putting your money into many different assets, such as stocks, bonds, properties, or funds, to reduce risk. By doing this, if one investment performs badly, the others can help balance it out and protect your whole portfolio. On the other hand, concentration means putting most of your money into only a few investments you strongly believe in. If those do well, you can earn more, but if they fail, you lose more too. Concentration can be powerful, but it requires deep knowledge and confidence that most new investors are still developing. So, in practice, holding fewer than 10 investments is called concentration, while 10 or more is seen as diversification. Why consider concentration? When you're just starting out, you may wonder why some investors choose concentration instead of spreading their money across many investments. Concentration means putting most of your money into a few choices you strongly believe in. First, the rewards can be bigger. Think about Warren Buffett in his early days. He made concentrated bets on a handful of companies, and those choices paid off in a huge way. Second, it's easier to track and study fewer investments, since you can spend more time learning about each company or asset and build stronger conviction in your decisions. Concentration also builds confidence and teaches discipline, since putting your money where your belief is requires focus and patience. Finally, there's emotional thrill too. Backing your own ideas and watching them grow feels exciting. Of course, this style comes with more risk, so it's not for everyone. But if you're a beginner who wants to learn deeply and feel connected to your choices, concentration can be a powerful way to start. Risks and challenges. Putting most of your money into only a few investments can feel exciting, but it also comes with big risks. Prices can change very fast, which can cause big losses if things go wrong. To do well with concentration investing, you need strong knowledge and discipline. Beginners often do not have these yet, so it can be tough. There's also the emotional side. Watching one investment rise and fall can create fear, greed, and panic, which may cause you to change your mind too quickly or hold on too long. Beginners also face the problem of limited research, as they may not fully understand the company or the market. Without the safety net of other investments, the chance of losing increases. That is why concentration is not suitable for money you cannot afford to lose. If you want to try this style, make sure you study carefully, stay calm, and only use money that will not hurt your life if the investment fails. Confidence is good, but smart caution is even better. Beginner steps to get started. Now, if you're a beginner curious about trying a concentration style in investing, it can sound powerful, but it also comes with risks. Before you jump in, let's break down how to get ready. The first step is knowledge. Take time to learn about industries, read financial statements, and understand big trends in the economy. The more you know, the stronger your choices will be. Next comes risk management. Do not put all your money into one pick. Decide how much to invest in each idea. Set limits to protect yourself, and spread your conviction bets just enough to stay safe. Mindset is also key. Investing with concentration means you need emotional control. Fear, greed, and panic can push you to make bad moves. So practice patience and build conviction in your research. Then think about capital allocation. Keep an emergency fund and use a mix of core investments with smaller satellite bets so you are not exposed to one single risk. Finally, never stop learning. Track your ideas, study what went wrong, and learn from mentors or experienced investors. Concentration can be powerful, but preparation is what makes it work. Building a concentrated portfolio. A concentrated portfolio means putting your money into just 3 to 5 investments you truly trust, like picking a small team where each player must be strong, reliable, and able to make a real difference. So how do you decide what goes in? Choose investments with solid basics by checking their financial strength or reliable support. And also look at growth potential, since you want assets that can rise in value over time. See if they have something special that keeps them safe from competitors or big changes in the market, like a popular brand or a company that owns patents protecting its products from being copied. Now here is the important part. Concentration means higher conviction, but also higher risk. If one choice struggles, your portfolio feels it more. That is why you need to manage risk by mixing different types of investments or by not putting all your money in at once. Done with care, concentration can be a powerful way to grow wealth while staying disciplined. So now you get the big picture. But here's the thing. How do you actually put this into practice without feeling overwhelmed? Let's break it down into simple, practical tips for beginners. Set a clear investment theme. Pick 1 or 2 areas, such as stocks or real estate, to focus on. Stick with them. Keep your portfolio sharp and disciplined, and prevent spreading money across random, unrelated investments. Set a capital allocation rule. Set a capital rule with a simple guide of 5 to 10 investment holdings, where each takes about 10 to 20% of your portfolio, so risk stays balanced while focus is maintained. This way, no single mistake can wipe out your portfolio, but you still practice the discipline of concentration. Start small, scale up as confidence grows. It's safer to begin with small amounts in a few focused investments, which limits risk while you learn. As your knowledge and confidence grow, gradually increase each investment to build discipline while avoiding big losses early on. Develop strong knowledge. Study how investments work, their risks, and what drives their value by spending about 5 hours weekly on books, courses, or reports in your chosen area. The stronger your knowledge, the more confident and focused your decisions will become. Build a mentor or expert network. This means connecting with 2 or 3 trusted experts in your chosen field. Meeting them every few months provides advice, improves your plan, and helps you avoid common mistakes, so you gain confidence and make smarter, more focused investment choices. Manage risk with simple rules. Set clear limits, like checking again if an investment drops 25%. Write these rules in your own plan and review them each year to stay disciplined and protect your portfolio while focusing on a few investments. In conclusion, concentration investing can offer big rewards, but also carries big risks. Beginners should prepare well before starting, since success depends on knowledge and discipline. Start with a mix of broad and focused investments, then shift more into concentration as your skills and confidence grow. Thanks for watching. Please like this video and share it with your friends and family to inspire them on their financial journey. See you next time.